Because sometimes when we've got confidence on the broader stock market, it can permeate into different areas of the financial markets. Is there more appetite now because the stock market has been climbing?
Yes, there is. I think that the restrictiveness of the debt lending markets has come off quite significantly in the last 6 months. Just in the last 3 months, we've seen more dividend refinancings in the private markets. So it's a great tool of private equity to refinance its debts, and they've done that to be able to show that they can send liquidity back to their investors. This was a market that was essentially shut for all of 2023. We're seeing good signs that the syndicated term loan market in Europe is back up and running and functioning, albeit at higher rates. And it's all because banks now need to compete with this private credit industry that has burgeoned over the last 5 years to come and compete with them for lending.
Can I ask you about the pipeline then? Because it feels as though we've got IPOs back on the table. We were talking to a company yesterday that wants to come to market soon. Is that helping the private equity side that there's now an exit in sight again down the track?
Well, I think it is actually a key leading indicator for why the markets are saying we have to open the IPO window. We've got to figure out how we get this liquidity to be generated in the capital markets, because a lot of these private companies are on a clock. Private equity being a 10-year life vehicle, 4 or 5 years to make investments, 4 or 5 years to exit them. And this is an industry that has essentially sat on its companies and done very little with them by way of exiting in the last 18 months. Now, they can't be on hold forever. Their investors demand cash back. And that has become a huge rallying cry from large institutions saying, start selling these businesses and give us liquidity back, including to the public markets.
So is there anything that could thwart the IPO window for the rest of this year? I mean, it looks okay. What we're setting up for rate cards, so if that happens, you think it would be an okay environment. But what could get in the way? I
think exogenous shocks remain a real threat, whether that's coming out of geopolitical situations, whether that's coming out of a shock to the markets. If there are no rate cuts or very few rate cuts that end up coming down the pike, that will be restrictive to the markets. I think the other thing to watch is technical flows, because a lot of what's happened to drive the US market in particular is the rush of capital away from China, away from even the UK FTSE, into the US market that has ridden up many of those indices.
Yeah, you got me thinking, actually. Is it exogenous shocks that the problem, or actually lack of realism from the sponsors of these IPOs? Time and time again, they blame market volatility. Oh, we didn't do this, we didn't go to market because the market volatile. Market's fine for the right price stock, as we've seen with Nvidia, as we've seen with ARM. You know, if it's the right stock with the right growth potential and the right pricing, it will fly regardless of exogenous stock. So do our dear friends who sponsor these IPOs, are they just wholly unrealistic about what they're trying to get for their money?
Well, I think the bid-ask, if you will, has come down quite a bit over the last 18 months, because that's the only way the window opens up, right? Unless you get the bid-ask to clear and expectations to reset.